In today's episode, I'm going to be walking you through step by step how we was able to find and identify this 28 risk to reward opportunity in London session. Okay guys, let's get into everything. So I want to first start by demonstrating the exact model that we use to get into this position first, theoretically, with the lines that you can see. Now before I do that, I want to genuinely give a full disclaimer. The average R multiple is not 28 in here at Prosperity Academy. In fact, these trades are very rare indeed. However, they do occur from time to time. And this was one of those opportunities in August that presented itself for one of those larger price moves. And there are many reasons behind why price sometimes offers something along the lines of 28R and then other times offers something more along the lines of 7R or 9R or 10R, which are more usual R multiples. Let's get into the video. So the first stage of this strategy is understanding the market structure, and specifically market structure on the 15-minute time frame. So by applying our mechanical model of how we interpret market structure, it's going to look along the lines of something like this. Price has a low, we come up, we put in a high. From there, we just understand that we have a low and a high. Until the high gets broken or the low gets broken, we don't know whether we're bullish or bearish. So what we need to do is mark out our high and our low like this, and we're just waiting for a breakout of either the high or the low. In this scenario, as you can see, price breaks to the high. So we have a break of structure to the upside, which of course indicates that we are indeed bullish. From there, essentially, we've had a higher high, higher low, and then higher high. So price is continually putting in this bullish price action. From there, what happens is price comes down. You're expecting, of course, a higher low, and then higher high, right? That's your expectational order flow. But what price does is it puts in its higher low and then comes up and puts in a lower high. And so then once price starts moving away from there, essentially you can already kind of conclude that this high has not been taken out by this low. So that is typically the first sign of a reversal. When price sits in a range and is indecisive. So when price comes up, comes out, doesn't break the low, doesn't break the high. When price is playing with that sort of price action, that's a typical indication that price is about to shift, because what price is doing in that area is essentially either reaccumulating positions or getting ready to distribute, and a distribution of positions. In this scenario, what we can see is price comes back down into an area of demand, then has a reaction back into the prominent area of supply, and then we actually break structure to the downside, giving us a change of character. Of course, change of character is being the shift from one market direction to the other. If you use the analogy of the characters of the bear and the bull, then essentially those two are your characters at all times. And essentially if the bull is in control, i.e. price is putting in higher highs and higher lows, and then all of a sudden we put in lower lows and we shift to bearish, well, now the bear is in control. That's just a shift, a change of those two characters. That's the best way that I can put it. From there, we have our change of character. Now price has shifted bearish. So we're no longer looking for long opportunities, of course. Now our bias is shifted and we're looking for short opportunities. So there are a couple of different ways we can play it. The first one is playing the level in here that actually caused the change of character. And then there are occasions where you may play the origin if this high gets liquidated. But in this specific scenario, we play the origin. And then from there, we have an area of supply, our point of interest, and then as price makes its way back up into this area, what you will typically see is this entry model right here on the right-hand side on a lower time frame. And then essentially on the 1 minute time frame, we'll have this bullish price action, exactly the same. This is all fractals. Price is moving bullish, and then it shifts to bearish, and then we get in, and then we go down. It's the exact same thing. Price is bullish, changes character to bearish, we get in, and then we play the down move. And so essentially what we're waiting for is, as price has just broke structure to the downside, right, changed character, as price comes back up, correction, on the lower time frame, it's going to be bullish, right? That's just how fractal market structure works. And so what we need to see is an area of interest be tagged and also respected. And of course, we understand and interpret that respect based off of our lower time frame shifts. And so what we want is a lower time frame realignment, as we will call it, inside of a higher time frame relative to point of interest. And from there, what we've done is we've confirmed this area and this structural high with our lower time frame, which gives us an additional layer of confirmation that price is ready to move to the downside and take out this low down here. And that is when we're able to execute this up in this area right here and get out down here. So that's the exact step-by-step of this. And then I'm going to essentially demonstrate now what that's going to look like in real market conditions. So here we are on GU, the 15-minute time frame. Now, of course, to understand where we presently are, which is in this range right here, we have to understand where it is that we've come from. So if we just come back a little bit and let's say we just go from the most obvious structural range, we have a low here and a high in here. And what this high has done is we've broken structure to the upside, right? So we'll break a structure to the upside. Great. So at that point now, we understand that we are bullish. So we have our bias, step one. And then it's really just about following price until we continue or reverse. So what we want to do is, typically what I will do is draw the range on like this from the high to the low of the range. And then price will break out of one side, because that way you know that anything inside of this low and this high is indeed just internal range. So we're going to map this out right here as our swing low, and we're going to map this out up here as our swing high. Now there's something very important that happens here, and I want to give you guys this gem. It is that the swing high gets liquidated, right? You can see that it gets broken, and it gets broken with a wick, right? So here at Prosperity Academy, we have a very mechanical rule-based system for how we interpret market structure and everything for that nature. So in our plan, in our mechanical system, for us, price has to break and close above the previous high in order for it to be a break. And in this situation right here, again, you can see attention to detail. If we go right there and we pull it down, straighten it, you can see that price does not break that high with a close. It actually just wicks it. So that to us is a liquidation. If this happens, then it equals this, right? And then what we get essentially from there is the high. We need to be very accurate in making sure that we understand, did price break and close above this high? Yes or no. So we touched it right on there. We're going to straighten it, and then we're going to conclude. Yes, price did break and close above the high here. Great. So that is our break of structure out of that price range. And that's exactly how we do things. Everything has a rule-based mechanism behind it. So that being said, what's happened is we've had a higher high, higher low. This is not a higher high because this is a liquidation. This does not count. Price pulls back, that's all internal. Then we break structure right up here, higher high. And that indeed is our break of structure. Break of structure to the upside. Awesome. So now we have higher high, higher low, higher high. Now notice that this right here produces what? A new higher low. How do we know that? Because it meets our rule-based mechanical system of understanding structure. Again, we have very set parameters in place that tell us, is this a pullback, yes or no? And this one meets our parameter, which is 3 candles in the opposing direction that succeed each other. That's our principle. If it meets that, then it's a pullback. If it doesn't meet that, it's not a pullback. And again, you have to have these mechanisms in place if it is accuracy and consistency that you're looking for. So from there, we have a break of structure, we have a pullback, and then we have another break of structure to the upside. So we're just following price action at this point. We have a break of structure. Now notice that this isn't our higher high because it doesn't give us the pullback that meets our mechanism. Then we go to the next high. Does it meet it? 1, 2, 3. Yes, it does. Great. So that's our new higher high. So we've gone from higher high, higher low, higher high. This is our higher low because it meets our pullback. And then this ends up being our higher high. This does not meet our pullback. So that is our current market structure range. And then from that moment right there, you have your swing low that at the moment is a strong swing low because it's just done what? Broke structure to the upside, break of structure, and we have our swing high. Now, if market is going to continue moving in the same direction that it's been moving in, we're going to expect some sort of lower high or higher low, sorry, and more than likely a respect of this area of demand. Price will come into it and then go and put in a higher high. Well, notice that price comes into it and respects it and then pushes out from it, which we're expecting. But then what happens is price also comes into an area of supply and respects the supply. And so that's the exact analogy that we had. And so what happens is now it's really understanding that if price is going to do this, it's more than likely price is accumulating because it's sitting in a range, or it's going to be a reversal because price should not be respecting areas of supply if we're going to continue moving to the upside. So what happens? Price break structure, we come in, we collect our demand, we come back up, we collect our supply, and supply ends up overriding that area. So in there, we have our change of character. And again, it's just a process of going from bullish to bearish in this specific situation. Now, again, we have to understand our pullback rule. So does this count as our lower low? Well, we need to go in and monitor price very closely and understand, do these three candles break and close above each other in succession? 1, yes. 2, yes. 3, yes. Okay, cool. So that is our pullback because it meets the exact plan that we have lined out for it. So this is our lower low, lower high, and then lower low. And then this lower low produces this complex pullback. So at that moment in time, and again, this is just building the story. All of this is building the narrative to understand where we are in the present moment. Because to understand where we are right now, we have to understand where we've come from. And to understand the whole picture, we have past, present, and future, right? So we have to understand where we've come from, to where that puts us now, to where that's going to send us. And then our job is to get involved in the end part, which is based on where we are now, where are we going based on where we've come from? And that's the whole 3-part story of price. And so what you see is we have a lower low, lower high, and lower low. So now we have a new swing high up in here and a new swing low. And so essentially price is just ranging between that high and that low. And if price wants to continue moving bearish, as it's just proven it does, then we're going to get a respect of this high and then a continuation of the low, right? And that's exactly what happens. You can see that price puts in a low right here, and then we have a complex pullback. And inside of this complex pullback, we have our internal structure. So we have our IC higher high, higher low, higher high, higher low, higher high, higher low, higher high. This is our internal price action. And then we have the shift in here. This internal shift right here, going from higher high to lower low internally, indicates to us that this swing low is now ready to go. And that's exactly what happens. But it does it with such an aggressive force of momentum that there was no opportunity to get involved in this price leg. So from there, we've had what? A break of structure to the downside. Break of structure to the downside. Now what we've had is, now we have a new, what? Swing high. Swing. Now we have a new swing high and a new swing low. So that is currently our trading range. And again, this is going to indicate and show you why this was such a large trade. So we have swing low down here and we have swing high up here. The risk to reward, the R multiple that we take in a trade is irrelevant of anything other than market structure. It's simple. If we are bearish, we're looking to short in the higher part of the leg into the weak low. If we're bullish, it's the opposite. So notice when you're looking in here, look at some of these trading ranges, right? Some of these trading ranges are super small trading ranges. And those are, the more typical trading ranges that you'll see. The small to medium size. That's where you'll get your 5Rs, your 7Rs, your 9Rs, and your 10Rs. And then there will be occasions where your price leg, the range of price is so large. For example, this high to this low is huge in comparison to this high, this low, this high, this low, right? This one price leg is larger than both of these price legs combined, and probably double. So that is the explanation behind why it's such a high R multiple, because it's completely mechanical. The R multiple is mechanical of the system. So lower high, lower low. Great, so we are bearish. So that brings us up into the present moment. And again, I'll bring this on right here because you can understand that this is the exact session that we trade. Anything marked out in gray box like this is the session that I will trade. So this gray box here represents the Asian session, and then this represents the Frankfurt Open. Then we have 60 minutes of Frankfurt into 11, which is London Open. For my time, I'm in Dubai. So 11 is when London opens, and this is the 3 to 4 hour window that I will look at getting involved in every single day. And so London opens for us, And where are we? Well, we have a high, we have a lower low, and now it's about identifying the point of interest for us to get involved in this position. Very important thing I want you guys to notice here is the gap that price makes to the downside right here. Essentially, price pulls up, high impact news event comes in, we gap down to the downside. Now, very rarely do we have gaps on the FX market. It's super rare. It's usually in extremely low or high areas of market volatility. So in this specific scenario, we have this gap right here, and anybody who's ever traded anything like futures understands that the majority of the time gaps get filled because essentially it acts as an area of imbalance in price that needs to be rebalanced. So we have that as our number one area of interest. It's essentially the area that, we have some level of pullback and then continuation to the downside that gapped, and we have the final buy to sell candle that created that. And then secondary to that, we have the point of interest right up here in the origin of the move, which is the final buy to sell before the huge area of momentum come in. So we're looking at these two areas, and we want exactly what we mentioned before. We want to get into these areas, and then once we're in these areas on a lower time frame, we want to see our predominant entry model, which is, again, as price is coming back up to price, it's going to be bullish, right? On the 1 minute time frame. Then we're going to get a shift. And then on that shift, we've realigned the 1 minute with the 15 minute. That's indicative of lower prices. Essentially, we're perceiving the data flow of orders, the order flow in the present moment on the 1 minute time frame. So we're getting a very close in look of how orders are interacting with each other at this very moment. The moment that we see the sell orders, right, the amount of liquidity that there are in sells outweighs the amount of demand that there is, we instantly know that price is going down. It's just a simple law of economics. And so we're able to identify that based on a 1 minute internal aligned with our external, because we already have the bias that price is going down. And then from there, we want to get involved in this area that causes this down here, and then take price down to the 15-minute low. So that's the exact entry model. And I'm going to show you exactly step by step how we're able to identify that here in the London session. So once you meet your point of interest in here, you do have to drop down to your 1 minute time frame. And of course, on your 1 minute time frame, you're going to identify what the present market structure is and then how it reverses itself, essentially. So again, to understand this exact same mechanism of structure, to understand where we are right now, we have to understand where we've come from. And then by understanding where we've come from and then where we are, we're going to get to understand where we are going. So without further ado, let's pull price back to the most recent structure leg, which was, does this break and close? Nope, liquidation. So let's come into, okay, well, we end up breaking this anyway. So let's just come into the market structure. Essentially, we had a high up in here. So we had a higher high, higher low, higher high. Then we went lower low, lower high, 3 candle pullback, no, 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 yes, awesome, great. Then we went back to bullish. That was our market structure. Then we went from bullish to change of character, bearish. So we had higher high, lower low. Now we're bearish in the 1 minute time frame, and then we don't break it from there. So the range indeed actually was this high to this low. And to break out of that range, we needed to see the swing low. And again, super large trading range in this area. We needed to see this swing low down here be broken for a change of character. Why? Because this was actually our range. It was a larger range than usual. Swing high to swing low. So everything else inside of this low and this high is just internal noise, right? So what we needed to see was if price is going to shift back to bearish, we need to see one of two things. Either number one, we need to see a break out of the high, which gives us a higher high, then a pullback, and then another higher high. So now we have our swing structure in here, and then we have our realignment of swing structure, and then we go lower, right? Or it was going to be something along the lines of this one. It's just a simple break and close of the lows down here, which would give us the change of character. So let's see how price actually plays out on this 1 minute time frame. So there you have it. that is, and again, this is London Open, pretty much exactly 11 a.m. for me, GST. You can see we actually get that break. So from there, we can go change of character. Now we need to identify where we're going to be getting in, because what have we just done? The most important thing is we've gone from bullish, right? We've gone from essentially being bullish to being bearish, then having a pullback, and then continuing bearish. So right now, our swing structure is from our swing high up here, and we don't know where is our swing low yet because we haven't had the pullback. So this is our swing high. So now we have lower high and lower low, right? So now we need to identify, great. Step one, we know where we are on the 15-minute. We're inside of an area of interest that's looking to go lower. We've refined now we're in a 1-minute time frame looking for our entries. And by doing that, first we have to understand the market structure. We know where we've come from. We were bearish. We had a shift bullish, and then we shifted back bearish. Now we've had a continuation of that bearish price action. So we know that we're bearish. So the 1 minute is bearish inside of a bearish point of interest on the 15-minute time frame. Great. That's a very clear indication that price is now ready to go lower. And most importantly, it's going to take out the 15-minute week low if it wants to continue adhering to the present market structure. And the 15-minute week low is down here. So it's our job now to get involved up in here to take out the low down here. It's that simple. That's our target. So where do we get in? That is the question. This is where my upward refinement comes in. What I will do is, if there are many points of interest, for example, on the 1-minute time frame, if we look at the different points of interest, we can see we have this point of interest right here. This one interests me the most. Why? Because as you can see, price comes down, respects the low, comes up, and then shifts from this. This is what we would call the decisional area, the deciding area of supply that broke the low. So that's our decisional. So that's our first area that we are looking to take the short from. The second area, of course, is the origin. If we're looking at price again, we have this as our decisional, and then of course we have our final buy to sell of the origin. What I like to do, especially when the price ranges are large, I will refine up to the 3-minute, possibly even the 5-minute, depending on how messy it is on there. So when I come to the 3-minute, I see very clearly that we have two clear points of interest. We have point of interest number 1, and we have point of interest number 2. So it's my job then to first position on this 3-minute in here. 3 pips, I'd like to go with 3.5 just to give a little bit of a buffer to the upside. Yes, it makes the risk reward a little bit lower. However, more importantly than the potential upside is the potential downside. So we want to be capital preservation first. And we're just targeting the swing low down here because it's just structure. All we're doing is understanding structure from a fractal perspective. If you just look at things from a 15-minute time frame, we essentially had 15-minute lower high, lower low, lower high, and then inside of here we've had our 1 minute that was bullish all the way up, now shift from being bullish to bearish. And so all we're doing now is trying to get involved in this and take out this low, which is the most probable evolution of price. It's that simple, guys. And so from there we have our entry on here, and we're just looking at taking out the lows down at the bottom. And notice price comes back, price tags in. At the point in which price breaks this low down here, we're going to break even. And then it's just a case of letting price play out however it's going to play out. And then you can notice that my session ends here, but the position remains open nonetheless. Stops are already at break even. Partials are already off the table. So at the end of the day, all that really matters is just letting price play out. Price plays out, and then we open the high volume 60-minute session in this area right here, which sometimes I'll come on for a scalp. And then price runs all the way down eventually to our take profit level. And that is the full breakthrough, step-by-step, top-down of how we use one of our models to get into the market and get out of the market. I hope you guys enjoyed that video. If you did, subscribe, like the video, and let me know, what do you want to see next? Ciao.